The Oval Office is in chaos. Donald Trump slams a red folder on his desk and shouts, "They have to give us magnets or we hit them with 200% tariffs." But the magnets he's talking about aren't ordinary. They're rare earth magnets, the lifeline for U.S. fighter jets, electric vehicles, missile systems, and the backbone of modern industry. And here's the problem. Beijing controls nearly 90% of the global supply. Within hours of Trump's threat, China strikes back. Beijing strengthens its currency, moves to corner U.S. assets, and leaves Wall Street's trillion-dollar bubble looking exposed. The real question now isn't whether a trade war is brewing, it's whether America has any credible cards left to play. Behind Trump's bravado sits Treasury Secretary Scott Bessent, who's pushing a very different gamble. In his view, the U.S. bond market can be rescued not by factories or exports, but by digital tokens. Stablecoins, he argues, will create a new artery of demand for U.S. treasuries. In July, Bessent framed these coins as saviors of the bond market, insisting they would buttress the dollar's reserve status. Goldman Sachs piled on, predicting a $1 trillion stablecoin boom, citing Visa's estimate of $240 trillion in global annual payment flows. The pitch is simple. Every digital dollar backed by treasuries creates artificial demand for U.S. debt. But there's a fracture in this logic. Propping up a currency through financial engineering is not the same as protecting its role in global trade. And Beijing knows it. President Xi Jinping is focusing on what really matters, commodities and exports. Just weeks ago, China's central bank set the yuan's daily fixing at a 9-month high. At first glance, this looks counterintuitive. Conventional wisdom says exporters benefit from a weaker currency. Yet Beijing deliberately strengthens the yuan, even while Trump ratchets tariffs higher. Why? Because China imports discounted oil and raw materials from Russia. That cushions its factories against rising input costs. A 2% or 3% yuan appreciation barely dents competitiveness. But the signal to global investors is profound. Stronger yuan assets mean higher returns compared to dollars. Goldman Sachs calculated that every 1% rise in the yuan can boost Chinese equities by 3%. The capital inflows outweigh any export hit. Beijing is cornering U.S. assets not with tanks or tariffs, but with a revaluation that makes Wall Street look fragile. Meanwhile, Trump's tariffs are multiplying pain inside the U.S. Effective rates now average 17% for industries dependent on imported inputs. Semiconductors from Korea, chemicals from India, electronics from China. Costs have surged 15 to 20%. Tariffs were supposed to revive American manufacturing, but instead they magnify costs, especially as the dollar itself weakens. Bloomberg reports the dollar has slid nearly 10% this year. That erased foreign investors' gains in U.S. equities. An S&P rally of 9% simply vanishes once adjusted for currency losses. This is the dreaded double whammy. Protectionism raises costs, while a weak currency deters capital inflows. China, by contrast, strengthens its yuan to attract global money. Margin debt on Wall Street just crossed $1 trillion in July, according to FINRA. A market driven by leverage looks strong on the way up, but the moment investors pull back, debt turns from fuel into fire. By holding the yuan steady, Beijing doesn't even need to sell U.S. treasuries to spook markets. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. Trump insists America still has leverage. Boeing, 200 of their planes couldn't fly because we weren't giving them parts, he bragged after meeting South Korea's president. The implication? Deny China Boeing components and Beijing will fold. But look closer. Airbus in Europe is already signing massive new contracts with Chinese airlines. Meanwhile, Comac, China's state-backed jet maker, has begun rolling out its C919 passenger jet. Cutting off Boeing may simply accelerate Beijing's pivot to Airbus and domestic aircraft. Trump's so-called leverage risks eroding Boeing's duopoly instead. This is the structural imbalance. Rare earths and magnets flow one way, from China outward. Airplane parts, by contrast, have substitutes. In negotiation theory, the side that can walk away holds the power. Beijing can withhold rare earths without crippling itself. Washington cannot stop importing them without gutting its own supply chains. And America's missed opportunities make the imbalance worse. Brazil holds the world's second-largest rare earth reserves, around 20% of global deposits. Washington could have partnered with Brasilia to develop them as a counterweight to China's dominance. Instead, the U.S. slapped tariffs of up to 50% on Brazilian exports. Investment dried up, the mines never scaled, and Beijing tightened its grip. Today, Reuters reports that China controls over 60% of rare earth resources and 90% of refining capacity. Brazil could have been the answer. Instead, it's Beijing's refining industry that reaps the rewards. Back in Washington, Bessent doubles down on his stablecoin pitch. The Genius Act passed in July aligns state and federal frameworks for crypto tokens backed by treasuries. Goldman Sachs projects that Circle's USDC could grow 40% annually through 2027, adding $77 billion in market cap. But critics are clear. Stablecoins recycle existing dollar demand. They don't generate new trade flows. They redistribute money rather than increase net demand for U.S. debt. Beijing, meanwhile, is altering global trade flows by adjusting the yuan itself. This comes at a time when U.S. debt costs are spiraling. According to the Congressional Budget Office, interest payments now exceed $1.2 trillion annually, more than America spends on defense. Bessent's digital token solution looks more like a band-aid on a hemorrhage. The paradox is stark. Washington leans on financial engineering, while Beijing leverages commodities and trade. Of course, China's calculus isn't risk-free. A stronger yuan squeezes small exporters with razor-thin margins. But the timing is deliberate. Global disillusionment with the dollar is spreading. In June, U.S. allies like Japan and India cut their treasury holdings, shifting into gold and alternative currencies. Beijing seized that moment. Goldman analysts noted that a 2% yuan appreciation coincided with a 7% surge in Chinese equity inflows. Investors go where returns are higher and currencies are more stable. Nationalist rhetoric doesn't matter in asset allocation. Profit does. And so the ironies stack up. U.S. tariffs meant to weaken China instead raise American costs and make Chinese goods more competitive abroad. Aviation threats meant to pressure Beijing end up fueling Airbus and Comac. Tariffs on Brazil killed a rare earth alternative, locking in Chinese dominance. Even when rare earth exports from China to the U.S. surged 660% in June, followed by another 76% jump in July, Beijing's new reporting rules gave the state tighter control. They can flood the market one month, then choke it the next. Dependence deepens, not shrinks. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.